Surging energy prices renew inflation fears. That's what we're going to get into today. Among other things, welcome to SRT Live with me, your host, Sean Richard, with the Sean Richard Mortgage team here at Guaranteed Rate. Thank you so much for joining me. First and foremost, I hope everyone who did not have to work yesterday had an amazing 3-day weekend. You got to recharge the batteries and prepare for just hitting it hard this short week. Welcome. So we are going to get into a number of different things, but for those of you who didn't see the news, Russia has temporarily, well, indefinitely shut down one of its natural gas pipelines, and the expectation is that that is going to double energy prices into Europe. And so that's a huge deal. That is causing inflationary fears, because if energy prices rise like that, it likely means that we're going to continue to see global inflation stay quite high, and interest rates in particular don't like inflation. So we're seeing interest rates rise today on this news that came out on Friday. So let's get into last week's numbers. Last week, relatively light news week, but we did have some pretty big numbers come out. So first and foremost, on Thursday, as we always do, we got the unemployment claims or jobless claims. And that's comprised of initial claims, individuals filing for unemployment for the first time, and continuing claims, individuals renewing their unemployment benefits. So we actually got some pretty decent numbers. You know, the expectation for initial claims was 248,000. We actually got 232,000 new claims, below expectations and a little bit below what we saw the previous week of 237,000 claims. Continuing claims came in right on the button. 1.438 million was expected, and that's what we got. And that was actually up a little bit from the previous week at 1.4312 million. So one of the talking points that I've been covering over the past number of weeks has been what trend are we seeing in jobless claims? And the expectation is that the trend has been that we've been rising. Earlier in the year, we saw numbers sub 200,000 week over week. We got up into the 250,000 range, and now we seem to have come back down a little bit. So again, we want to watch this. We're looking for trends. We're looking for, not the anomalies. Was this dip in last week a little bit of an anomaly, or was it part of a bigger trend? That's what we want to watch. Last week, we also got two giant numbers. We got on Friday the BLS Jobs Report. That's the Board of Labor and Statistics. And the expectation is that we were going to see 300,000 new job creations. Well, guess what? We got 315,000 new job creations. So a little bit of a win there. Normally, you would see a much more positive result or reaction from the markets, but we did not see that because the unemployment rate actually ticked up from 3.5 to 3.7%. You may say, well, Sean, hold on, wait. How do we get a positive jobs report? We beat expectations, but somehow we managed to increase on the unemployment rate. Well, I want to show you a graphic real quick, so that way you can get a little bit more of an insight. So check this out, folks. Let me see if I can enlarge this just a little bit. Here we go. Let's do this. Boom. All right. So the August jobs report, 315,000 new jobs. Now, the last 2 months were actually revised lower by 107,000. So that played a role as well. But when it comes to the unemployment, there's two different reports. There's the business or establishment survey, and then which determines the BLS jobs numbers. But then there's the household survey, which is actually the survey that determines the unemployment rate. So check this out. We had 442,000 job creations on the household survey, but 363,000 of those were for 16 to 19 age range. Now, what does that mean? That's still job creations, right? It is. But the key there is that those jobs created are primarily to individuals that are typically entry-level jobs that are not going out and doing significant spending. And so although we get some positive jobs numbers, the outlook from an economic standpoint was not as robust because of where the jobs came from. Now, if we look at the total labor force, 164 million, that actually rose by 786,000. So although we had a healthy number of jobs created, we also had the total labor force increase by more than the number of jobs created, which is what ticked the unemployment up from 3.5 to 3.7. So it's always nice to dig a little bit deeper into these numbers. The headline numbers are always there. They're going to catch your attention, and it's better to dive into those details to look a little bit further in how we got to those numbers. So that was the jobs report and unemployment from last week. Light news week to this week, as I mentioned, we've actually got three things that are really on the radar. As always, on Thursday, we get jobless claims, we get unemployment claims. We also, on Thursday, get the ECB rate decision. So this is the European Central Bank rate decision. And this is going to be one to watch because as you heard me just say, we've got a spike in energy prices across Europe with Russia shutting down the Nord Stream natural gas pipeline. And so what is the central bank, the European Central Bank, going to do? Are we going to see another rate increase, which has been extremely rare for the ECB? So we'll keep an eye on that on Thursday. And then on Wednesday, we also hear from Jerome Powell, Fed Chair Powell, which is always potentially market moving. I believe the last time that Jerome Powell spoke, we lost billions, possibly trillions of dollars in the stock market over his 8-minute speech. So it'll be clinging to every word of what he says heading into the second half of this week. All right. So what are we watching? What are we looking at going forward? So this week, I want to talk about consumer credit just a little bit. Credit card balances had their largest year-over-year increase in the last 20 years, and that was 13%. And so consumers are very concerned with the economy. You've got rising prices across the board, and that has caused a lot of consumers to turn to credit cards to help them pay for their monthly expenses. It was actually credit card debt was up 46 billion in Q2 from Q1. So just in Q2, just that 3-month span, 90-day window, credit card balances rose by $46 billion across the US. So we're running into some potential for a consumer debt crisis, and we want to keep an eye out for that. Now, from a housing standpoint, one of the things that my team and I can do is obviously help consolidate debt, leveraging the vast amount of equity that homes have built up over the last several years as well. So if you're a homeowner and that's something that you are looking to possibly help with any crushing weight of debt payments, then reach out, talk to my team. My number's right there. If you're a real estate agent and you're helping homeowners or home buyers that are maybe selling a current home, there's an opportunity for them to sell the current home, purchase the new home, and then leverage some of the equity. Instead of putting it all down on the new home, leverage some of the equity to help put them in a better financial position. My team and I have those conversations with clients all the time as well. So consumer credit, very important to watch going forward. And then next is, of course, inflation. Obviously, those surging prices in Europe. We do live in a global economy nowadays, and those surging prices are just an indicator that inflation or higher inflation is likely here for a while. And inflation is the enemy of mortgage rates. And so today we saw mortgage rates tick up by a healthy margin. Hopefully we can rebound, but until we get better news associated with inflation, it's going to be tough. We do have some inflation reports coming out this month. We've got CPI for the month of August. That's Consumer Price Index. That's coming out on September 13th. So that's coming up. We also have August PCE, which is personal consumption expenditure. That, ladies and gentlemen, is the Fed's favorite measure of inflation. That's the one they're trying to get back down to around that 2% mark. And then the Fed meeting is September 20th and 21st. So we're going to hear from Jerome Powell on the 21st of this month. Unfortunately, we're not going to get another PCE report until after the meeting, but we are going to go get that CPI report, which I'm sure is looked at by the Fed, even though it's not their favorite report. So some big inflation data coming out over the next week, couple of weeks. We're going to hear from the Fed with their meeting, see what they decide to do with the Fed funds rate. The expectation is that we're going to see anywhere from 0.5 to 3/4 of an increase in the Fed funds rate. Now, side note, remember, this does not impact your mortgage interest rates. Mortgage interest rates are long-term rates. The Fed funds rate is short-term rates. So things like credit card interest rates, car loan rates, personal lines of credit, those are impacted when Fed increases the Fed funds rate. On the positive side, increasing the Fed funds rate typically is going to result in banks increasing the return that they give on savings accounts as well. So something to be excited about, a little bit of a silver lining in the land of inflation right now. Well, that's all I've got for you today. I really appreciate you joining me for this episode of SRT Live with me, your host, Sean Richard, with the Sean Richard Mortgage team here at Guaranteed Rate. Until next week, have an incredible rest of your week. Take care.